Welcome to The Financial Edge. I'm Erin Kennedy. Is a Roth conversion right for you? Today we're going to talk through 3 considerations before you make any money moves. Today's guest, Chris Hoffman. Chris is the founder of Hoffman Financial Group, an Atlanta area firm that focuses on preparing people for a successful and happy retirement. Chris is also the popular radio show host of Money Unleashed, and Hoffman Financial Group is the official partner of the Georgia Bulldogs. Chris, it's very good to see you.
Good to see you.
Chris, Roth accounts have so many benefits. It's hard to break them all down, but it's so great to create, tax-free wealth, tax-free growth, tax-free distributions, inheritance. Yep. So if we are considering a conversion, there are a few things to consider. The first one, what will your future tax rate be? It's hard to
This is hard to predict. So not only do you need to look out and kind of make some predictions on tax rates and how it will impact you, you need to take a look at your current tax rate too. Because if we convert, it's under the current tax levels, which are looked at as pretty favorable right now. So in 2025, you want to study and seriously consider, depending on your mix of money, how much do you have in your tax-free bucket? How much is taxable money? It's called non-qualified funds. And then how much is in your tax-deferred bucket? Now, in the 80s, when we created the 401k plans, there was no Roth 401k. So there's a tremendous amount of money out there that is going into retirement that the government is staring at saying, we want the billions of dollars to be taxed. So they're coming after that. Our job is to decouple from income tax and have our retirees not pay income tax, pay capital gains tax only, or pay no tax. That would be tax-free. So we need to study current tax levels, predict out tax rates, and keep that pre-taxed bucket under some level of management. And I'm not saying it can be an equal split, a third, a third, a third. People will panic when they hear that because they've been putting money into their 401k for years and years and years. But if you're still working, maybe flip it and contribute only to your Roth 401k to make up that gap. Or if you're retired, we can consider doing a Roth conversion. You want to stay, if you're doing a Roth conversion, you want to stay in that 22% federal tax bracket. The next jump is 24, not a big jump, so stay inside of that bracket. Talk to your financial advisor about it. Also have your financial advisor talk to their tax specialists on staff or talk to your tax professional or CPA.
The next consideration, ask yourself when you will need access to those funds. Why is that important?
So at 73, you're going to need to pull down required minimum distributions, right? So that's a forced tax. Whether you need that money to live on or not, it's coming. And they increase the percentage year over year over year. So it's going to, the intent of a pre-tax IRA is the IRS wants you to take all of that money out in your lifetime. If you pass away prematurely and their money is left, if you leave it to kids, they need to take it out in a 10-year period of time. So that's the trap. We need to decouple from that and figure out, do we take money from our pre-tax IRA before age 73? Before the government tells us we have to, should we?
Right.
So should we take out pieces of it to lower our future tax burden? We can map that all out for callers in our full financial planning process.
I feel like if there were a litmus test, if somebody were saying, should I consider a Roth conversion? It comes down to one thing. Somebody's going to pay the tax on that account. It's going to be you or it's going to be your beneficiary. Which do you want?
That's right. And typically when we pass away, our kids are going to be at their highest wage earning years. Right. So they're not inheriting a sum of money, they're inheriting a tax burden. Right. So you do need to look at it and prepare for it, and we certainly can help with that. That is the number one tax trap, I believe, that the IRS and the government have established for us. Now, pre-tax money, growing tax deferred, I love it. It does help us to grow our portfolio. But nobody ever walks into my office for the first time, and when I ask them, how much do you have in your 401k, they say $1 million, and they look at me like that's all of my money. And I have to break it to them that actually maybe a third of that is going to go to the Fed and the state tax. And that's a tough conversation to have because it level sets when people say, if you have $1.5 million, you can retire. Oh, yeah? If you have $1.5 million in tax-free money, you probably can. If you have $1.5 million in pre-tax, taxable at income level rates, you may need to assess it and do a deeper dive into it and balance it out a little bit.
Right, a very different answer.
Yep.
So one vital bit of information, Chris, the reason you and I are talking today is because tax rates are at historic lows. Many financial experts believe the Tax Cuts and Jobs Act of 2017 reduced federal income tax levels to the lowest they may ever be, and these cuts are set to expire at the end of 2025.
Yeah, so that covers the entire United States. I'm focused on pre-retirees and retirees. So my mission and our firm's mission is to decouple retirees from income tax. We want capital gains tax only, and we want tax-free money only. Can that be done? You'd be surprised. If you have around $500,000 in pre-tax 401k or IRA, it's entirely possible that you can draw down and use that $500,000 and never pay tax on it. Now, when you get up to $1 million or 1.5 or 2 million or your high net worth, $5-10 million in pre-tax, that's a bigger strategy discussion that we need to have about conversion options and gifting away some of those RMDs so you don't pay taxes on them in your lifetime. But it depends on the individual couple or the individual and what their total mix of assets are. And then what do they want to do in retirement? How much do they want to spend? How quickly are they going to want to spend it? I encourage my retirees to spend a ton of money in the first 10 years. Go and enjoy it. Let's build a financial plan around front-end loading your income and avoiding taxes for you to live your best life in retirement in the first 10 years.
The answer is not going to be yes for everyone.
That's right.
But the answer is have the conversation today. Crunch the numbers today.
Yeah, and I believe we can find a yes in there somewhere because life doesn't stop and you can't work forever. And a lot of people don't want to work forever. So we've got to find that yes answer for our clients. It may take 3, 4, 5, 6 financial plans that we create. We're willing to grind through those to the point where you look at us and you say, I can do this. And you get excited about retirement. You're not fearful of it.
Yeah, we love them, but you got to break up with Uncle Sam at some point. Right?
Eventually you do. That's right.